Welcome. Today we're diving into everything that's been happening with NIO lately, and let me tell you, it's been a pretty wild ride. The stock has surged this week, and there's a buzz growing about two major possibilities. First, that the company might actually be closing in on profitability, and second, that a short squeeze could be brewing just beneath the surface. Whether you're already holding NIO, thinking about getting in, or just curious about the EV space, this is the kind of week that makes you pay attention. Let's start with the momentum that's been building. In June, NIO delivered nearly 25,000 vehicles. That's a 17.5% increase compared to the same time last year, and it's pushed their Q2 total deliveries to over 72,000 units. That's not a small number, especially considering the level of competition in the EV space, both domestically in China and internationally. These delivery numbers have helped inject some optimism back into the market, something NIO investors have been craving for a while. Part of this delivery strength is coming from their newer model lineup. They've launched the Firefly compact car, the Onvo L60 crossover, and they're gearing up to release the Onvo L90 SUV. And let's not forget about the ET9, which is expected to be a flagship model aimed at a more premium market. All these launches suggest NIO is trying to widen its appeal, from entry-level mass-market buyers to higher-end consumers, while still keeping innovation and tech at the core of their identity. But where it gets really interesting is NIO's commitment to finally becoming profitable. They've publicly set their sights on breaking even by the end of Q4 2025. That's a huge deal for a company that's burned through billions in development costs, expansion efforts, and R&D. Now, they're tightening the belt. R&D spending is being slashed by around 20 to 25%, bringing it down to roughly 2 to 2.5 billion yuan per quarter. On top of that, they're aiming to keep selling, general, and administrative expenses under 10% of total revenue, which would be a significant improvement. All of this is part of a bigger shift within NIO. They're moving toward what their executives call ROI-based management. It's a fancy way of saying, every dollar spent has to show a return. And that mindset is being applied across their entire operation, from vehicle development to marketing to infrastructure. Now let's talk about one of the most unique pieces of NIO's puzzle, their battery swap network. It's been a controversial and ambitious part of their strategy, but it's starting to show real promise. NIO currently operates more than 3,100 swap stations across China. These are fully automated, allowing drivers to pull in, swap their depleted battery for a fully charged one, and drive away in just a few minutes. No waiting around to charge. It's a convenience factor that could become a competitive edge. And here's the kicker, some of these stations are actually becoming profitable. NIO recently said that most of the stations in Shanghai are already operating at or near break-even. Even more impressively, around 20% of their stations across China hit break-even last year by hitting a key benchmark, performing 60 to 70 swaps per day. Analysts believe that if these trends hold, the entire network could reach profitability by 2026. That changes the math entirely. What once looked like a money sink could become a recurring revenue engine. But let's not pretend this is all smooth sailing. In their most recent earnings report, NIO posted a net loss of nearly $930 million. That's still a significant cash burn, and it means that while break-even is the target, the runway is still long and filled with obstacles. For NIO to reach profitability, they'll need consistent execution, delivering cars on time, keeping costs in check, and finding efficiencies in their supply chain. And of course, macroeconomic conditions, like interest rates, consumer demand, and geopolitical tensions, could throw curveballs at any time. Now let's get to the part that's really electrifying traders right now, the short squeeze potential. As of the end of June, NIO had roughly 191 million shares sold short. That's about 9 to 10% of its publicly traded float. To put that in perspective, it's a large enough percentage to make short sellers nervous if the stock starts moving sharply. Combine that with the fact that average daily trading volume is sitting around 50 to 55 million shares, and you've got about 5 days to cover. That means if shorts need to buy back their shares quickly, it could take several trading sessions to unwind all those positions, and that could drive the price up very quickly. Add to this the fact that the cost to borrow shares has gone up. That's usually a sign that the supply of shares available to short is getting tighter, and it increases the pressure on short sellers. This creates a setup where even modestly bullish news, like a better-than-expected delivery update, new vehicle release details, or guidance from management, could trigger a scramble. Once that starts, the momentum can feed on itself, pushing the stock higher and forcing more short sellers to cover. That brings us to Friday. This is a key moment. NIO has had a strong week, with multiple days of gains and trading volume spiking to well over 100 million shares per day. If that trend continues, and we see even a slight catalyst, whether it's from NIO itself or from broader EV market sentiment, Friday's trading session could get very interesting. All eyes will be on whether the stock can push past recent resistance levels. If it does, we might see a sharp, accelerated move upward driven by both retail traders and short sellers rushing to exit their positions. But let's stay grounded. While the short squeeze setup is real and the profitability path is starting to come into view, NIO still has a lot of work to do. It needs to keep growing deliveries, maintain investor confidence, and navigate a very competitive market. The Chinese EV space is crowded, with names like BYD and XPeng also making big moves. And on the global stage, NIO still faces challenges breaking into established markets where Tesla already has a foothold. Even so, this week's rally wasn't just a fluke. It's been supported by real progress in deliveries, operational discipline, and an improving narrative around NIO's long-term viability. Whether or not we see a full-blown short squeeze or a sudden burst toward profitability, the underlying signs are becoming harder to ignore. So as Friday's session kicks off, watch the early trading volume. Watch for any pre-market announcements or news leaks. And keep an eye on how the broader market is behaving, because sometimes all it takes is one spark to ignite a bigger move. Thanks for tuning in. I'll be keeping a close eye on how this plays out, and if there are major developments, I'll be back with another update soon. NIO is showing signs of life again, and if nothing else, it's one of the most interesting stocks to watch right now.